welcome everyone. This is our session number 31st, our weekly meeting on every Saturday, 10 a.m. I'm excited to be here and thank you for sparing time to join me in this. Today, we're going to talk about biggest IPO and some story behind the scene. And we will go through some of the company earnings. We're going to look at lot more stocks today and talk about earnings than what we have generally done in past few sessions. But I added one more topic today morning after I updated the agenda in the meetup. I was reading through an article and I thought, I think this should be good to discuss in our meeting. So I will talk about that as well. But let's talk about the week that it has been. What a volatile week it has been from both what's been happening in the country from political perspective as well as what we have seen in the markets. We're not going to discuss any politics or any political affiliations here. All I hope is each one of you have done your civic duty. Don't care whether you voted for Democrats or Republicans or Green Party or Libertarian, that's your prerogative. But I do hope that you have voted. You have made your voice heard. And then we leave it to the rest to the results on how those show up. But at least we have done our part. And then now we see what happens. All right, so let's get into our meeting today. Any questions, anything? We just finished October, 2 more months to go in this year. And what a month October has been. Personally, it's been one of the better months for me. And we got 2 more months. Hopefully, don't see any more stupidity in the market. We make our portfolio to work in any market direction. We should be exiting this year in much better way than what S&P 500 has done. So we're chugging along. November expiration trades winding up, and now I'm putting December trades. So I'm pretty happy based on what we have done this year. All right, before we dive deeper, quick usual disclaimer, anything that you hear or see in this webinar is not an investment, financial, or tax advice. Believe me, you're taking any tax advice from me is the worst thing you could do. I have a background in technology, spent more than 2 decades in software industry. So don't ever take those advice from me. Anything that you hear or see is just for education. So treat it that way. Don't go and trade based on what you hear. Okay, let's dive into today's meeting. Like I said, we've got a lot of stuff to cover. So let's do that. Starting with market wrap up, things change. Market has an uncanny ability to surprise everyone. We were, before getting into elections, we were saying if it is if Democratic Party wins the presidency, it won't be good for markets because of more regulations, higher taxes, blah, 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 blah. The moment we saw and noticed that there's going to be a blue wave, narrative changed. Hey, we're going to get stimulus. So if there's a blue wave, we're going to get a stimulus. It'll be great for stock market. And then we realized that it is not going to be a blue wave as such, which was expected, because there was still close fight between the current president and the former vice president. And then we found out that the House and the Senate would be split. Market still loved it. Split Congress means dysfunctional government, means even if we have a Democratic president in a White House, nothing much can be done. No big changes in the legislation can be brought in. All the discussion around curbing technology firms putting in more stricter regulations around tech firms, then that will never happen. So markets still went up. And now we realized Mitch McConnell came and says that unemployment numbers looks great. No, we are not in a mood to talk about stimulus, and markets still didn't care. So then we don't know how markets will behave, and that's why we should always position assuming that it could go either up or down. We shouldn't, by this time, then we should be tired of trying to guess the market direction. And let's not put more faith on the talking heads who themselves don't know where the stock, market will go. So a quick recap, previous week, this was the status. I mean, previous week means not the week that just went by, but a week before that. Everything was in red heading into election week. Election week, everything turned into green. Go figure. We talked about some of the reasons. Now, what this coming week will bring for us, who knows? Is this green sustainable? I don't think so, but we've been proven wrong multiple times. So I don't want to position myself thinking this rally would continue or this doomsday scenario will be coming. We don't know. But quickly, I mean, S&P, all big market indices were up. S&P up 5%, Dow Jones up 5%. Tech, which was a train wreck previous week, went up almost 8%. Good thing was that the VIX came down. The biggest uncertainty around the election was over. So VIX fell more than 50%. And that was really good for a lot of positions. Like I had mentioned in the chat, a lot more positions has suddenly hit our profit targets and we were just closing it. Even though in some cases the stock probably had not moved, but because of the drop in volatility, the whole premium got sucked out and we closed many of the trades. Let me know how you did. Much anxious about it, or I mean, I still stayed in the portfolio like I talked about last Saturday. I'm not selling my portfolio thing, going into elections thinking we don't know where the markets will go. So it could go down. I did that mistake in 2016 because that time I wasn't trading options. So I sold off a chunk of my portfolio and then had that seller remorse. I didn't want to do that this time. So I stayed invested and I'm glad I stayed invested and I plan to continue stay invested even, going forward. Just that we put all our hedges, make sure if market falls 10%, 20%, we are not hurt that much. That's my game plan. I don't want to cash out and pay taxes to IRS and then wonder when to get back in. I still continue to stay in. Job reports, Ross says white male unemployment rate is 5%, other 9 to 14%. Stimulus may not be coming. That's exactly what I heard Mitch McConnell saying, hey, job report is pretty good. So, and if the House and the Senate stays divided, we may not be having stimulus. Last count I checked today morning, looks like some of the news media, Associated Press, they've already declared former vice president as president-elect. Some of the other channels probably have not done it. I have not gone through all of them. But one thing which piqued my interest was the Senate composition. It's 48-48. It's both the parties are equal numbers as of today morning. So if it flips and House and Senate both go to Democrats, we don't know how market will behave. We rather heard many theories of what will happen if Democrats win or if Republican win, and then market does something which nobody would had expected. So if Senate flips to Democrats, and then we have a House is already with Democrats, and then White House, if that goes to Democrats, will that be bad for tech companies as it has been talked about? We'll see how market behaves. So that would be interesting. So, and not to mention that our incumbent president's team will fight tooth and nail to figure out how to stay in White House, and then maybe some legal lawsuits. We'll see how it happens. Again, we're not here to talk about who's right or wrong, but just that the drama may not be over. So we might get a little more opportunity if volatility kicks up next week or week after that. We might get more opportunity to sell a little more premium. All right, from an indices perspective, though a little lower than their all-time highs, what we have seen in September, QQQ is still doing pretty good. Almost 36%, less than 40% we have seen earlier. Gold is 27%. Dow Jones and IWM have yet to regain their start of the year. They are still down from where they started the year, but that's where we are. So if your portfolio has been tech heavy portfolio mimicking QQQ, probably you've done good. If it was a balanced portfolio as SPY, you have still done better. You are still better than what you were at the beginning of a year. And gold and bonds, who would have thought that golds and bonds will outperform a diversified equity portfolio? But that's what the current situation is. Let's look into COVID situation. I generally don't discuss this, but I think with the whole focus on election will not be dwindling, at least we will get back to the real situation and what's the dire situation, I would say, in our country. Probably this did not get as much highlight as it should have, but the daily number of cases are more than 110, 120K. These are more than what they have ever been in US. Not a good situation at all. This is not flattening the curve. As I see it, this is completely opposite. It's moving into parabolic fashion, going higher and not coming down. So we have to be really careful now with onset of winter. This might probably get worse than what it has been. And if Joe Biden becomes president, and he may have a different way to handle this COVID situation that could put some brakes on our economy. Who knows? We'll have to see, but I think we should keep an eye on what's happening in this pandemic situation. Markets have ignored it for quite some time, at least for the last few months, but it is rearing up. It's raising its ugly head again. So let's be careful. Total number of deaths is not showing any sign of slowing down. Even I don't have the data for hospitalization, but what I heard, even the number of hospitalizations have been increasing in many, many states. So once this whole attention from elections is out, probably we will start to see more information on COVID, and maybe market will react to it. That's yet to be seen. So that brings me to the next topic, which like I mentioned, I was reading an article today. And again, I liked what I read in terms of the way the numbers were presented. Now take it with a grain of salt, because every analyst, every investment house have their own perspective on market. So for us as an individual investor, it is good to know the different perspectives and then make our own decisions. So we have heard a lot of perspective around why the markets are behaving the way they are. It's tech companies, the earning results are all great. The big FANG and the market cap companies like Tesla, etc., they're gonna change the world. So all the valuations are justified. But it's always good to look on the other side and see the arguments from the other angle also. So I was reading through this today morning. So I added it into our today's discussion. So I read a report and it starts with like this, history does not repeat, but it rhymes. We all know that. And as such, we are struck by eerie and dangerous parallel between today's market and the markets back in 1999. 1999, 2000, we had the whole NASDAQ crash, tech companies overvalued, and people were putting money left, right, and center, thinking that markets always go in one direction. Again, I'm not predicting anything here, but just a different viewpoint I want to bring forth and discuss with you guys. Other thing, valuation spread between US and emerging markets were wide. US was witnessing speculative and bubbly behavior on part of retail investor. That's what was happening in 1999. But today it is not 1999. We are in 2020. And we know that these big companies, FANGs, they are not part of bubble. These companies have real products. These companies are not webvan.com, pets.com, flowers.com, who only had websites. These are real big companies. We use these products daily. So, and those companies being valued at where they are, those may not be the problem. Interest rates are significantly lower today. Fed is backstopping the markets. We recently heard from Jerome Powell this week that they're not going to make any changes to interest rate. Fed will use all the tools that they have in their toolbox to be ready to support the market. And frankly, when I was listening to Jerome Powell, I'm like, I could go back and hear his speech a month ago, exactly the same. There is no difference between what Jerome Powell had to say this month or the previous month. And the whole narrative was still the same. We're not going to change the interest rate. We want lawmakers to do their part by doing the fiscal stimulus. Fed is not in a business of spending. We can only do and manage monetary policy, which we are doing. And that's it. We have all the tools in our toolbox. I don't think any Fed chairman can come and say, sorry, we can't do much. Now it's up to the lawmakers. We have done all what we could. So I don't think any Fed chairman will say that. So in Jerome Powell, he's very well polished, I would say, bureaucrat. And he did the politically correct thing, saying Fed has all the tools available and we will deploy as and when needed. And I don't even know what else tools now Fed has, but we'll see. It's a debatable point, but that the lower rates should lead to higher equity valuations. Right? But we all know that history never exactly repeats, but it just rhymes. So today we are seeing a lot of factors which are similar to what we have witnessed in 1999. So let's look at some of those factors. Ross says, which report is this? This is by an investment house, GMO, Ross. So they came out with this particular article. I liked it because they talked about numbers. So there could be a decade-long negative rate of return for US large cap equities because the valuations are a ridiculous level against a backdrop of pandemic and global recessions, and especially the CAPE level, which is cyclically adjusted PE. It is well above 2007 levels as well. So we all know what a PE ratio is. PE is basically price divided by earnings, which tells us how expensive, what's the price we are paying for stock or a basket of stocks or the overall stock market based on what's the earning expected out of it. Higher the PE ratio, higher the amount of price we are paying for the future earnings. At some point of a time, it could get ridiculously high, which could be unsustainable. Now, CAPE is cyclically adjusted PE ratio, means it would adjust itself for the market cycles, which I find is better than the static PE ratio. Right? But it gets worse. Treasury bonds are the most expensive they have been. Obvious reasons, the rates are so low. The yields is so low. So given the amount of yield, the bonds are super, super expensive. So we have a situation where the stocks are equities are overvalued from a CAPE perspective, as well as the bonds are overvalued from a yield perspective. Right? So the traditional portfolio of 60-40 probably will not work. And then they had this graph of growth of dollar of a 60-40 portfolio, right? At a different CAPE levels, means cyclically adjusted PE ratio, and at a real yield level, how those decades have done. Right? So we're starting from 1900s to 1920, the overall yield was negative, CAPE was 22. From 1930s to 1940s, another decade, almost 7 years, another one for 9 years, another one for 11 years. Now for last was around 2000 to 2010, 1 decade. That's what this called as lost decade, wherein the markets, the 60-40 portfolio didn't yield anything. Right? Are we back to the similar levels? That's what this report says. Growth is trouncing value today. Ross says, so is it correct time to get out of bonds now? We know that bonds are not yielding anything anyway. And how do we protect ourselves from the overvaluation in equity? Ross, we have to move into a different, I would say, asset classes. Right? Should we trade in VIX or should we do hedges using options? The 60-40 is what this report is concerned about. Growth is trouncing value today. That's what we see, all those big techs, because those are growth stories. It's got a ridiculous PE of 400, doesn't matter, it's a growth story. Companies like Zoom and some of the other companies, I think Twilio, etc., have got price over sales ratio of 40 plus. It's okay, it's a growth story. In 1990s, same thing happened, late 1990s. Value was out of favor for more than half a decade. Many of the value funds were losing clients. I just noticed in Wall Street Journal, I think it was this week or a week prior, a very old value investing firm had now closed their business. They're returning all their money to their clients, just like things that happened in 1990s, late 1990s, because they are just not able to give the same returns what growth is giving right now. So we're seeing, it's like a deja vu. We're seeing a lot more value firms now folding their shops. 1999, the Russell 1000 Value Index had underperformed its growth cousin in 7 of the 11 preceding years, and that too by huge margins. So if we are thinking that growth has been doing good for 5 years or last 6-7 years and it will continue to do good, we don't know. We have a history where the growth has done superbly good for 7 years, and then for the next 7 years it was a time for value. So from 1999 to 2006, value beat growth by cumulative 99%. Fast forward to today, we are seeing similar patterns out here. Value shops are calling it quits. I already talked about one. I read in Wall Street Journal. The pain for value investor has lasted even longer, and the performance spread has even become worse. This time, in this decade, value has lost to growth in 8 of last 11 calendar years. And that too by much wider margin. I see a question from Ross. How about GARP growth at a reasonable price? What do you mean by GARP, Ross? Oh, growth at reasonable price. Yeah, but the prices are not reasonable. I think that's the whole point, is the prices are ridiculously high as compared to the expected growth. Growth at reasonable price is what we want to be in, but right now the S&P is not there. If you look at overall market, today it is even more expensive than it was pre-COVID level, which is, ridiculous. We all know economy is and is not expected to be better than what we were expecting it to be before pandemic hit, but the market is expensive. So here's the difference between late 90s and today's. The difference between the value and the growth. Point. Spread between the value and the growth is now at 4.5 standard deviations. Right? We trade options. We always trade in sigmas or standard deviation, right? Go out 1 standard deviation, sell, strangle, and then hedge your risk, get a tail risk for 2 or 3 standard deviations out. So when I looked into this report and talking about, okay, 4.5 sigma event, I'm like, okay, let's look into it. What exactly does it mean? So COVID-19 growth rally of 2020, we started on March 23rd. We all know this was the lowest point this year, and it continued all summer. No surprises here. From March to August 31, a 113-day run, growth was up 77%, beating value by 32%, which is a 4.5 sigma event. Officially happens once 403 years. So here is the difference between, this is 103 market day returns of Russell 1000 growth companies. 6.1 standard deviation. We saw this growth of 77%, which is 6.1 standard deviation event. In just growth. Growth companies growing by 77% in 113 days is 6.1 standard deviation event. How long will it continue? I have my own doubts. The difference between growth and the value, 32% difference, is 4.5 standard deviation event. It's right here. Whereas historically, it's been, let's say, between 10% plus or minus. Most of the time it stays between this, but this time it is like 32%. Just some numbers to look at. Okay. Let's continue what it says. US is in bubble market today. Economy was destroyed by 19. Unemployment went from historic lows to historic highs, though now the numbers are looking better, but they're still not, they're still worse than what it was pre-COVID. Let's acknowledge that. But the current valuation of S&P 500 is actually higher. Right? Also, some of the worrisome signs are behaviors of speculative market and aggressive trading of retail investors. Media calls them as Robin Hood traders, but I'll just say retail investors. I have nothing against Robin Hood as a trading platform, but they got a bad name because most of the speculative trading activities arise out of their platform. Though relatively calm over a decade, past few months, we have seen the trading from retail investors have increased nearly 7-fold over 3 short months. That's what the numbers are. So this, what you see in red, is daily average revenue which these brokerage firms earn from the transaction activities. In last few months, what a difference. And we have seen many logic, about, we have read many reasons about it. We have heard CNBC and other media talking about it. People sitting at home because of COVID, people getting stimulus check that's finding its way into stock market, or I think this is the best time. It's a time to invest in growth, etc., etc., etc. There are always reasons. There would have been reasons in 1999, 2000. There would have been reasons in 2008, 2009. But just some numbers to look at. So I found this report quite interesting, just to get a different perspective, a complete contrary perspective to what the narrative that we have generally seen in markets and how markets have been behaving. Because one thing that I believe is market has an uncanny ability to surprise us. So it's good to be aware of a different perspective so that we are not blindsided by what we know and how we have structured our portfolio, right? Cognitive dissonance. If I am bullish on a particular stock, I will probably find all the bullish news about that stock. So I just want to avoid that. Hey, let's look at a different perspective. Let's look at what someone else has to say, which is completely different from what we are witnessing in the market. So I thought I found some of these numbers interesting. I thought I'll share with you. So I sneaked this topic for today's discussion. So current SP valuation. So this is S&P 500 valuation. I don't think they had a numbers for the tech or QQQ valuations. And again, there are only few companies which are driving QQQ. And if you really talk about Asif, Apple, I don't know what's Apple PE. Now it's 35 or something. I don't think it's cheaper than it was pre-COVID level. Let me just go to this and see where Apple is. Oops, 1 second. So Apple. So where we get Apple? 36. I don't think this is cheap. And if we find out a pre-COVID, I'm certain that it was less than 36. So it is definitely not cheap. Now, are we trying to rationalize the prices because, hey, it's going to change the world. We got a 5G tailwinds. We got a IoT coming in, and I'm not just talking about Apple, talk about Tesla and everything else. We could, but I think as a overall market, whenever we have had these historic highs and then crashes, there was always a reason to justify it. Right? The reasons could be different. That's why it is said that history never repeats itself. But it was a similar situation in 1999. So we have to be careful. Again, I'm not predicting anything, and those of you who attend this session, if someone asks me what's market gonna do, my answer is I don't know. And anyone else who tells you otherwise is ignorant of the fact that he or she doesn't know. The fact is that I don't know in short term what market is gonna do. Next 2 months, 3 months, 4 months, I don't know. So I basically will trade assuming that market could go down 10-15%, could go higher 10-15%. But I want to be aware of all the perspectives. Yeah, this is another one. Fed continues to flood the liquidity. Fed is backstopping this. How long can this happen? Who knows? Again, we'll only come to know once the event happens, and that's why they are called black swan events. Right? Anyone talking about a black swan event before the event happens will look like foolish, but once the event has happened, then all of us will think, how come we didn't see it? How come we couldn't figure out that there's a pandemic out there and the markets, S&P was 358 in January or February. How could we not see this pandemic impacting us? In a hindsight, it looks like it was so obvious. But before it strikes, any rational argument against the prevailing sentiment just seems so foolish. Okay. So again, today we have all the logic for why this is not irrational behavior. We got a Fed backstopping, we got interest rates which are zero, so there is no yields to be found anywhere else. We are expecting great growth. We got a companies that we have never seen before. But again, all those are reasons. If and when black swan will hit, and that's why it is called black swan, because nobody can predict it, we'll probably find reasons to then debate how come we were so blindsided to it. So we'll see. So I agree, valuations are probably higher than pre-COVID, although intrinsic valuation is probably higher now with COVID supported growth on e-com and other sectors. Again, there are some companies which have had enjoyed the tailwinds of e-com. Again, the question is this sustainable? Right? Market needs to be, in general, market is forward-looking. Are we going to sustain the similar level of growth what market is projecting in future? I think that's everything. Again, we don't have a correct answer. If anyone has a perfect answer to it, then there will never be a black swan event. But just an idea that what I liked is that all these similar sentiments or similar arguments which went against the current theme were poo-pooed earlier also and will be poo-pooed now also. It's only when the things hit us, later on we'll realize, okay, why did we not look into it? So I just want to bring another perspective. Okay. Yeah, Ross, if market is forward looking till it isn't, which can happen on a dime. Very true. Zero trade cost and commute time became the commute time is now trading time, and no trading cost. So it could be every time it is always a different reason. It's never the same reason, and that is why most of the time we'll say no, this time it is different. But it's never different. History rhymes. So just be aware of it and play it accordingly. Tina is encouraging. That's cool. All right, so let's look at the other market, the crypto market. Looks like even Bitcoin likes what it saw in the presidential elections, and this thing would have changed. I took the screenshot yesterday night, and we all know crypto is 24/7 and is a lot more volatile than the regular equity market. So as of yesterday night, Bitcoin was 15,670, close to that, and which is a historic price in terms of it. Now it is above 15,000, which I think for all the crypto enthusiasts, it is a historic milestone. So, but again, it could change anytime. I don't know what the real situation is. The exact number is right now. Ethereum was almost 460, and then some of the others. Good to see XRP Ripple is now 26 cents. So a lot of bullish narrative around Bitcoin. We talked about in our multiple sessions, and we'll continue to discuss crypto assets. But let's move on to next one, and let's play a game. Who wants to be a millionaire? The famous TV show, but this is actually, this company could have made millionaires if and when, if people would have invested it at the right time. So I just want to read through some numbers and want you to guess what company is this am I talking about. This is the latest Q3 2020 results. It's an e-commerce company because we are talking about gross merchandise value. It's up 117% year on year, $5.9 billion. The shipped means what they shipped is 140% year on year. Total items sold, 110%. Revenue is up 148%. Now, payment volume is up 161% to 14.5 billion. On means on their platform, by merchants on their platform, payment value from volume from merchants outside their platform, almost 200%. The net revenue from payments, almost 150%. Superb growth. Sales from mobile devices up 200% year on year. And this is not a company which is a startup or, it is starting from a lower base. We're talking here in billions, right? It's not that it has grown from $200 million to $500 million. This company is already selling in billions of dollars. They got 60 million unique pairs with net addition of 7.5 million coming in Q3. And then they talk about the credit, means this company also lend money. So they do microcredits, which is a new business, and that has been growing really good. So I do see some guesses here. Asif says Merly, which is Mercado Libre. Ross says Shopify. ER says Square. Then I got two guesses. Ramesh says either it's Merly or Shopify. Ross says Merly. Yeah, most of you got it right. It's Mercado Libre. No wonder that the stock is now what, 1400 plus, 1480 or something like that. And I'm still bullish on this. I've been in Mercado Libre for some time, and I do watch what they have been doing. And right now, it is still what, just 70 or $80 billion company. Despite all this growth, it is still small. So let's look at Melly. It is what? Yeah, $80 billion company. Could it become, $400, $500 billion in next 5 to 10 years? I think they could, because they are operating in a market where the e-commerce is still picking up. and Mercado Libre is the biggest player in that market. PayPal understood it long time ago. They had already invested in Mercado Libre. Unfortunately, PayPal's parent, eBay, their saga of bad decisions continue, and they divested from Mercado Libre and continue to focus on their own auction business, which we all know how that had been doing. But yeah, I think whoever took a decision of divesting from Mercado Libre probably will not get to make another decision in eBay. But anyway, I'm super excited by what we've been seeing in Mercado Libre. And I think it finished, 1485. It could fall another 10-15%, sure. But my thinking is there are enough tailwinds for this business to grow from a basis of $80 billion to be a $500 billion in a few years. Okay. So I want to stay invested in this one. And I'm sure whoever had been in this, say from when 5-10 years ago, or probably is already millionaire. All right, Ross's credit issuance gave it away. That's a new business, so I didn't know that this would be the one which will give away you the hint. But I was excited to see the results that they had to report. I did not expect Mercado Libre to do so good because they had already grown at a very good pace in the previous quarter. But I think they just blew the results through the door. But good to see. Next one, Airbnb. It is expected to file IPO docs in this week. So, which is, I'm excited. I'll jump on to its S1, see what we find in its S1. And if I'm able to finish that analysis, maybe we'll talk about it in our next session. But as we all know, probably this will be one of the largest stock market listings of 2020 in US. Later on, we'll talk about the world's largest. So I want to qualify it saying it could be in US. And I'm pleasantly surprised to see Airbnb filing and going IPO, because if you recall our discussion somewhere in May or April, we talked about how bad the situation was for Airbnb, and they had to secure emergency funding at an interest rate of 11%, where the Fed interest rate was nearing zero. Airbnb couldn't even find money. They had to pay through their nose to get, I think they raised $1 billion or $2 billion. They had to pay through their nose to get money because it was, the investor was thinking it's a dead company. So this is a dramatic reversal of fortunes for Airbnb. And I give all the kudos to Airbnb management from coming from where they were in March, April to where they have moved now. But again, I have to see the numbers in S1 to see, are they only going IPO because they want to take advantage of the exuberance in the market, or if the business has really turned around in last 6 months. I want to focus more on how the business or their expectations have turned around. In July, they did say that customers had booked more than 1 million nights in a single day for the first time since March 3. But I'll see what I find in S1 now. But the credit is due to the management team of changing the narrative on Airbnb in the market from being nobody wants to lend money to, hey, I think we have decent tailwinds and we can get good enough valuation. let's go IPO. Let me know what you think of Airbnb. So how many of you are looking to invest in Airbnb? Soon it goes IPO. Anyone? Or how many of you are confirmed that you don't want to invest? Okay. Asif says only if it doesn't pop like snow. Yeah, we don't know. It's all yet to be seen in terms of what's the valuation they are seeking and how it goes. But it's an interesting development in IPO market and specifically for Airbnb. Okay. All right, the next stock is NEO. I'm just saying, is it a bubble? Even though I'm a shareholder of NEO, sometimes it feels, hey, is it run up too high too soon? I don't know. So let's talk about it. So the NEO, they gave some pre-earnings number that in October 2020, the vehicles that they delivered increased by 100% year over year. And till 2020 total, by end of October, means 10 months, total number of deliveries increased close to 111% year over year. Right? Boom, looks like that was big enough a news for the bulls in NEO to push it from, let's look at where the NEO is now. I think now it is close to 40 or something. Or was it NEO or something else? Yeah, 43. Right. It was around here, and once that report came out on 2nd of November, let's zoom in. So this is 2nd of November, and all we've been seeing is NEO marching. It's run up. It's just been going higher and higher. Again, as of now it is valued, NEO's market cap is actually higher than GM's. Now we have seen this story before, right? For that reason, NEO is called Tesla of China. And could it become Tesla? Who knows? This is way early to predict anything. If it could become Tesla, then the current market price 40 is too cheap. But if we'll see what they have to report in the results, and if the numbers are not favorable, then they still will have to prove themselves a few more quarters. Okay? But I will continue to stay invested in NEO because my cost base is so low that it's not a big deal for me. But we saw some good movement in NEO in past few weeks. Next one, 12th birthday for Bitcoin. And like I mentioned earlier, Bitcoin was above 15,000, but now it's been trading above 10,000 for over 100 days. Generally, it is very volatile. We see Bitcoin moving a lot of, up and down a lot more than what we are seeing in recent times. The last time it was above 10,000 for so long was in 2017 and 18, where it traded only for 63 days and it came down. Is it a sign of a change? Well, maybe. Given the fact that all the central banks across the world are printing money. The Bank of England already started their next round of QE. And we expect that even in US, similar thing will happen, even though it may be more difficult to do it, but it could. Bank of Japan had already done it. So with every central bank printing machines working over time, people want to stay invested and are finding some store of value. It could be Bitcoin. There are other precious metals also. We have seen gold and silver also gaining steam in past few weeks. Again, a quick turn about from PayPal. We saw JPM had the similar flip-flop. In 2018, PayPal said Bitcoin is the biggest scam. And in 2020, PayPal is saying, hey, we'll allow the users to buy, sell, hold, and shop with Bitcoin. So nobody wants to be left behind. And we'll find a reasons to justify this. And now we'll find a reasons to justify this as well. So interesting. Let's talk about Square. Fiat currency losing relevance. Ross, yeah, exactly. That's what has been the narrative is across the world, is if all the central banks are just printing money the way they are, what's the relevance of it? Is it even worth the paper it's being printed on? What is that something that we can hold on to, which will still retain its value? Traditionally, that has been gold. And now there are more opportunities available. One of them is Bitcoin. And as we have seen in previous sessions, even some of the corporates, publicly listed companies are now holding Bitcoins. Since we talked about listed companies, there was also an interesting a news item. I don't think I mentioned it here. Is last week, there are many companies that keep an eye on what's happening on at least the Bitcoin ledger. And then they noticed that $1 billion of Bitcoins were moved from an address which wasn't touched for 5-6 years. And there was a chatter around, who is this big player, where the money is being moved to? I think it was on Friday, yesterday, eventually US government, declared that money, that $1 billion worth of Bitcoin was moved into IRS Bitcoin wallet, because those were the Bitcoins that they confiscated and eventually able to reclaim from the Silk Road founder. So those $1 billion worth of Bitcoins were moved into IRS's wallet, and now they will auction those Bitcoins. So which was an interesting one. Other interesting news was what the other big holders of Bitcoins, what they term as whales. The movement on the whales addresses is not happening. It means those big holders of Bitcoins, they are still sitting tight, even though Bitcoin had hit $15,000. So while many of those retail investors might be thinking to maybe let's take some gains, the big parties who own more number of Bitcoins, there has not been any movement in those wallets. Okay. Now, these things we can't even talk about in the traditional financial transactions space, right? There's no way for us to figure out who is moving money where. But because Bitcoin blockchain is publicly available, people do, and companies like Chain Analysis, they do run these sort of analysis looking at nothing has happened over these wallets which have, I forgot the number, I think more than 1,000, minimum more than 1,000 or 10,000 Bitcoins. Those wallets are just sitting tight there. So when this $1 billion got moved, it was actually in the news. Well, hey, what happened? Where does this $1 billion worth of Bitcoins are moving to? And then we figured out it was a US government. But the other big holders are just sitting tight. All right, coming to Square. All great numbers in Square. Profit up 60%. Cash App, which is their it's the latest innovation, and from where the lot of growth is coming in, was up 212% year on year. Net revenue up 140%. Amazing number from Square. And it also reflected in the stock price after the earnings announcement. So I still continue to stay bullish on Square. I think companies like Square, PayPal will become the future financial services company. And the traditional banks will lose, their relevance will start to decrease. I won't say they will lose relevance, but I think from a market perspective, they will become less and less relevant. And today, I think PayPal the market cap is higher than Goldman Sachs. The number shows. So I want to continue stay invested in these new breed of financial services company. Asif says, is it true? Yeah, Asif, you just jumped the gun. I was about to talk about that. Square said on Thursday, they sold 1.63 billion in Bitcoin through its Cash App during the third quarter of 2020. So yes, that is correct. So Ross says, what about MA and V? Correct. So I think I had my cash less basket or something like that. So I have, where's my CCC cashless. So these are my companies for future in the payment or financial services space. Visa, StoneCo, Square, PayPal, Mercado Libre, because they have a big payment system. They are not only the Amazon shipping the merchandise, they are also kind of a PayPal because they have their Mercado Pago payment system, which not only the merchants on their website can use, even the merchants or the companies that are not customers of Mercado Libre e-commerce system, they can use their payment systems. And I think in last 12 months, that segment has grown a lot. So I'm way more bullish on Mercado Libre from a payment perspective than as a e-commerce retailer perspective. Though it is both. Right now, it is both. So let's go back to Mercado Libre. And that's exactly what is termed as a total payment volume of. Means this is the volume of payments which is being transacted by merchants which are not on their e-commerce platform. Isn't it amazing that even the retailers that don't use Mercado Libre's e-commerce platform to sell their goods are actually using Mercado Libre's payment system to transact, because customers have what's called Mercado Pago. I just said that name and now it's skipping it again. All right, I'm getting old. This is a sign. Yeah, Mercado Pago, which is their payment systems. Customers have it on their phones and they demand, why do I have to now take out my card or anything else? So they go to a normal retailer shop and then pay using Mercado Pago. It's like if I go in Safeway and I'm paying through Amazon Pay. Amazon is not in that business, but Mercado Libre is in that business. So that's why I have this is my cashless MasterCard. We'll talk about Jumia and then Green Dot. So this is my cashless basket. And I think future is cashless. So Ross, yes, MasterCard and Visa, they are both on my list. And the other tailwind that these enjoy is if PayPal grows, so does MasterCard and Visa, because MasterCard and Visa provide the underlying infrastructure for paying through PayPal. Right? Or, I mean, that's what we do is if you PayPal, you can select which credit card you want to use. So they have their own tailwinds. Only area wherein MasterCard and Visa could be disrupted, and this idea only came to me last week, was what if we have CBDCs, central bank issued digital currencies. Today, central bank issues only cash and coins. And then MasterCard and Visa, they provide us a convenient way for us to not to carry the big cash and coins and still be able to buy goods wherever and however we want to. What if the CBDCs become more and more prominent and its usage increases for day-to-day transactions? Then I can just transfer it to any retailer through my wallet, which I have on my phone. Why would I need an intermediary to convert the cash into digital currency? Because I already have a digital currency from Federal Bank. This thought came to me while I was reading about the whole report around those 7 federal banks we talked about in the last week's session. But I think MasterCard is preparing themselves for this scenario. And they did talk about some of the patents that they are getting in this space of central bank digital currencies. But we still have to, right now this whole initiative is still on paper. There's a long way to go. Any thoughts on GPN and global payment? No, Ramesh, I've never looked into this one. I don't have positions on this one. So, no, I have no information on this one. I don't want to hazard any guess by looking at GPN, because that would be just foolish. They are 51 billion. What do? They provide payment services. Or payment technologies to take on tomorrow. So there are many companies that provide the technology for payments, right? And I think global payments could be one of them. I mean, there are many companies which work with these banks, etc. Those will provide the technology. And I don't know who's going to be the winner from those. So to me, it looks like one of those companies. Ross says, if Pago is gaining prominence, Visa don't have exposure. Don't. Yeah, so Melis, Pago is only in Latin America. It's not in US. They don't. Mercado Libre doesn't exist in US. So this is again my hedge against the US market is, invest in international companies. So Mercado is one of those. Okay, so let's look at the Square. Since launching Bitcoin purchase capabilities at start of 2018, they have now sold 3.4 billion in total sales. Now, looking at this number, that in one quarter they sold 1.6 billion of Bitcoin, will scare the hell out of others like PayPal. That's why PayPal is already into it. And I guess the other bigger companies also. Okay. So we have to see what happens in this race. But all right, so this is how the total volume of Bitcoin has been increasing and the gross profit that Square has been making through these transactions. I really haven't looked into in terms of how the Square makes money on this. Is it that they are taking some percentage off, or is it that they are buying on behalf of customer and it stays in Square wallet? How exactly that happens, I don't know. So I'll take it with a pinch of salt in terms of their gross profit from Bitcoin sales up 90% from last quarter. I want to dig deeper into it. If anyone of you had bought through Square Cash App and maybe want to chime in, you can enlighten all of us, educate all of us on how exactly Square makes money through Bitcoin. Anyway, the next thing that caught my eyes, cannabis stocks are now high. The stocks that makes other high are now themselves high. And this happened, I think, on Friday. Canopy Growth, CGC, was up 12%. Aurora Cannabis was up 60%, though the base is really, really small. But 60% up in a day is no mean feat. Not only that, we also saw a big move in Tilray. It was up 36%. Now close to $10. If we pan out, if we zoom out, we'll find out at some point of a time, Tilray was trading at $300. So this market has been a lot more volatile than even the Bitcoin market. And MJ, which is an ETF, that was also up 14%. Now let's look at some of the tailwinds. What's happening to cannabis stock? Why are they all going so high? Montana, Arizona, New Jersey, South Dakota, they approved ballot measures which are favoring the cannabis industries. That was the main reason. The other main reason is blue wave. So Montana has voted to establish 21 as a legal age to purchase, possess, and consume cannabis. And Arizona and New Jersey voted to legalize recreational marijuana. So we got positive movements in 4 states. South Dakota approved for both recreational as well as medicinal use. Also, Mississippi had a medical marijuana measure on the ballot, but the results are not seen yet. But combine the fact that it would be a Democratic president, the possibility as of Friday was that the numbers was favoring Democratic president, and more states approving the use of marijuana. It's a huge, huge tailwind for cannabis stocks. And that's exactly what we saw reflecting in the markets. Is it too much hope and hype? Could be, but I think it's a step in the right direction. Does it really warrant stocks going high 30-40%? May not be. But I think it's definitely more and more states legalizing it. The use of recreational marijuana is a huge tailwind behind this whole industry. Remember, at federal level, it is still illegal. But with the change in administration, maybe at a federal level, it could become legal. That's going to be definitely a game changer for this industry. It is already legal in many states. I forgot the number where we talked about it in Webinar 22. We did the whole detailed analysis and built out our investment thesis on cannabis industry. So we looked at the numbers at that point of a time. So many states in US have already legalized it, but we saw 4 more states moved in that direction. Now today, all these companies, most of these companies, they're all listed in Canadian exchange, the pure play cannabis companies, they're all listed in Canadian exchange because at a federal level, it is still illegal. Marijuana is still illegal. So if it becomes legal at a federal level, they'll have access to a lot more capital. They will have access to all the banking services of USA. They will be able to take all the losses on their balance sheet, which today they can't. So expect a huge, I would say, a gain on the company balance sheet or P&L statement, because they can now take the losses. So we still have to wait and see. I'm waiting for this particular moment, but it doesn't harm to start building positions. So after our webinar, I started building position on some of the companies that we talked about, and those have done decent for me. Yeah, most of the cannabis are still way down YTD. I think that's correct. But again, depends on stock. I don't think CGC is down. CGC. So let's look at YTD. CGC is all, from a year to date, CGC is up, but others like ACB, Tilray, they all are way down. Again, these ACB, Tilray, etc., they are pure play marijuana companies. And when we are talking about building investment thesis, my only thing was I want a company which has got a good financial position. And that's why I was been talking only about, where's the document? The CGC. And I thought I only want to pick CGC because they got a constellation brands behind it. To succeed in this industry, you need to have a lot of cash. Cash or debt, whatever. You need to have a lot of financial backing. And that's why I was on CGC. I think many of the others, which are just pure play marijuana companies, they are all down. But the companies which have other businesses along with marijuana, they have done better. Things like the company Grow Generation, Scott's Miracle. I am not in Grow Generation, so I don't recall what it's. There we go. Grow Generation has been up. Scott's Miracle. Then we have GW Pharma. This we talked about. GW Pharma is again up year to date. We talked about the REIT IIPR. IIPR has done wonderful good in last 2-3 days. And also after their results. So, but if you're looking at pure play cannabis, again, I think the rules of business have not changed. You still need to invest and you need a lot of money for that. Okay, let's move on. All right, other thing caught my eye is protection against inflation in measure shines. We talked about it earlier. This is our Fed balance sheet. We're already hitting, we are above 7 trillion. Probably we will do more with now Joe Biden as president-elect, as per Associated Press. There may be a better chance of getting a stimulus. While I know in the Senate they'll face a difficulty, but who knows? There is always executive measure, executive decisions. And our incumbent president has liberally used his power of executive decisions. So we'll see what happens. But interesting tweet from Winklevoss brother, one of the brothers of Winklevoss, saying the Powell's speech this week was a code for buying Bitcoin. And it's not just Bitcoin. Let's all look at the other assets which are considered store of value. We saw uptick in gold as well as uptick in silver. Both were high past week because of inflationary practices that we are seeing from Fed. So so this up move in silver did good for our position. So we'll talk about it. I've been traumatized by the whole silver positions, but now we are exiting slowly but slowly at profits. Uber and Lyft, they got a lift from Prop 22. Those who are in California, probably your mailboxes would have been bombarded by those flyers coming in, vote for 22 or say no to 22. And the end result was the California residents, they voted yes to 22. That means these ride-hailing companies and the food delivery companies, they don't have to classify their drivers as employees. So let's go into history. Somewhere in 2019, a measure was passed in California. I think it's called Measure AB, in which these ride-hailing companies and the delivery companies, they were to treat their contractors as an employee. That means they have to give all the benefits as any other company has to give to their employees. So Uber at that point of a time said that they would be pulling out of California, and then there was this Prop 22 was put in place, and then they, I think I'm hearing some background noise, so let me mute everyone. Okay. So what net result is, California voters have voted in favor of Prop 22, and that's why we suddenly saw jump in Lyft as well as Uber shares, because it's win for them. Now, most of the time, the rest of the states goes the way California goes. Now, I think all the attorney generals in other states have to think twice before they bring in, or the lawmakers, if they start to change or challenge the status of Uber drivers as contractors. But this was a big tailwind behind Uber and Lyft, even though Uber had a decline in gross bookings, but the stock was up because of Prop 22. Having said all that, Uber is now barely touched. I think it just touched their IPO price. So if we are having a FOMO of, I couldn't get into, when the company opened up, don't worry, we'll get chances again. Uber has provided that chance for more than 18 months. It's only now that Uber actually hit their IPO price. All right, yeah, this is what we saw in Uber and Lyft stocks. They all jumped 10-15%. Next thing that caught my eye was finally, first time, we got some positive assessment from FDA on Biogen's Alzheimer's drug. And I think this could be a savior for Biogen. It's been a very, very difficult space, especially on Alzheimer, to get any drug out. Studies after studies have failed. In fact, Biogen actually pulled out from development of Alzheimer. I think it was somewhere in 2019. And then they did another look at the data. They say, oh, no, I think there may be a way we can move forward. And then they start move forward. But last week, I was very pleased to see that FDA gave a positive assessment. So they haven't approved it yet. There's a difference between these two, but they gave a positive assessment. saying, I think it looks good. But if this finally get approved, Biogen is going to be the only company with an approved drug for Alzheimer. This will generate billions of dollars in new revenue. And no wonder, just on this news, Biogen shares rose 44%. And we are not talking about a company whose shares is trading at $10, $15, $20. We're talking about a company whose share was trading at like $250. It jumped almost 50%, right? 45% to hit a new all-time high of $366. So this huge skyscraper came from that news. I'm not a shareholder in Biogen just because Alzheimer was something in which almost all the companies that have tried to go through to find a drug for Alzheimer, they have failed over years. So I knew that Biogen is working on it, but I just didn't want to invest based on Alzheimer. But I think it's a great news for humanity. Now we've eventually, if that gets approved, we will have a drug for Alzheimer. See some comments. Shannon says trading was halted on VAB. Oh, okay. I didn't know that, but looking at this chart, I'm not surprised that trading was not halted. Oh, that trading was halted looking at such a huge jump in Biogen. Cool. The other similar thing, Qualcomm, they got a 5G tailwinds. We reported the results and said, Qualcomm said that the revenue jumped 73%. 73%, and which exceeded Wall Street expectations, and the share rose 13% higher. That's one of the companies that we talked about when we built our 5G investing thesis. It's playing out for Qualcomm. Again, a big boom after their earnings result. The other one caught my eye. Today we only going to talk about companies' results and what they have been doing. Appian. Appian was a low-code, no-code company. Again, we did some investing thesis on low-code, no-code, and we reviewed Appian. I liked what I saw in Appian. The cloud subscription revenue grew 40%. Subscription grew 34%. Total revenue is 17%. Gross margins, subscription 90%. Overall is 73%. So this company is growing, and I like that their subscription is growing way higher than their professional services, because subscription has got much bigger margin. And I like this chart. The subscription revenue is growing, professional services revenue is coming down. Eventually, it will become bigger and higher margin. That's where they'll get their operating leverage. So from a business perspective, more than double the new logos. So they're seeing a lot of traction in this low-code, no-code space. Right? They also got into federal industry as well as EMEA region. Again, you can look into the details of this, but the fact that this new trend around low code or no code is actually now becoming real. When we reviewed this, we looked at all the companies, and the only pure play which is listed in public markets we could find was Appian. And that's why we said, let's build our thesis based on Appian. There are some other that I think I was excited about. One more company, I'll have to go back and look into that thesis, but that is not public yet. So, but I'm going to keep my eye on that company as well. So no wonder Appian stock actually jumped to $90, their all-time high. based on what they've shown in their results. It was up almost 20%. And from year to date, the stock is up 135%. So good news for Appian. If you know of any other low code or no code, pure play, bring it up for discussion. I think I want to focus more on this industry. I know Amazon, Microsoft, all the big industries, they do provide similar ability, but I'm looking for pure play, in this market. Okay, let me sip some water. Okay, next I want to do a deep dive into the world's biggest ever IPO that had almost happened. I have prepared this deck, this content for a week earlier. And because this was supposed to go IPO on Thursday, and it did not happen. But that doesn't change anything about this company. So I want to talk about this company, and let's be aware of if and when this IPO happens, we should know about it and find out how we can invest in it if you want to invest in it. Okay. So before that, any questions on any topic? So now I want to do a deep dive into, and probably you already know. Okay, take guesses. Which company is this? Don't Google, please. Which company we're going to talk about? Ant. Exactly. It's not Baba. It's Ant. So let's first see how big would this be. So this is what it was supposed to be. So the biggest ever IPO has been Saudi Arabia's Aramco, in which they raised $29.4 billion. This happened only in Saudi Arabian exchanges. Second biggest was Alibaba, which happened on NYSE. Alibaba raised $25 billion. If this IPO would have happened on Thursday, the plan was to raise $34.5 billion, $34.5 billion, which would have been the biggest IPO ever. Okay. This company became the world's most valuable startup in mid-2080 when it got valued at $150 billion. But with this IPO, its valuation is well ahead of $300 billion. We generally see companies reaching this valuation after years and years of operations and in public market. But Ant, right out of the door, would have been a $300 billion company, bigger than, I think, Goldman Sachs. This would place it, find its place among the most valuable technology company as well. And calls themselves as a technology company. And there is a reason behind it, and we're going to talk about that reason. Ross is open mouth. Yeah, exactly. So let's look at the journey of Ant to IPO. It finds its roots in Alibaba. So just like eBay had created PayPal to facilitate payments among eBay users and merchants, Alibaba had created Alipay to facilitate transactions on their Taobao, which is their marketplace. In 2004, they created Alipay. Then they launched Alipay mobile app in 2009, in which you can pay using QR codes. This launching this mobile payment services catapulted Ant Financial. That time it was known as Ant Financials. It just exploded. Not only payment, they also launched the money market mutual fund. They also started providing loans to them, loans to consumers. They started Zima Credit, a credit scoring business in 2015. 2018, they started moving into insurance business. So from being just a payment company, in 10 years, Ant Financial became one of the biggest financial powerhouse in the world, definitely in China. If you really want to look at some of these numbers, Alipay has more than 1 billion users in China. And this is only in China. They have very less usage outside of China. This is mostly by Chinese expats or tourists who are visiting foreign countries. It now handles more transactions yearly than MasterCard and Visa, I think, combined. If you really look at this, in 20, and this is 2019 number, 2020 could be different. Alipay handled $17.6 trillion worth of transactions. Visa did 11.3, MasterCard did 6.3. So we consider, in the US, we consider Visa, MasterCard to be powerhouses of credit card processing, online payments. Alipay did $17.6 trillion. They got more than 1 billion users as their customers. They were the pioneer in QR code technology for payment. And it is so easy paying this QR code. Is all you need as a merchant to accept the payment is a printout. That's all. You don't need any machines. You don't need any scanners to receive mobile payment. All you need is a QR code. And in countries like China, and similar concept is in India, wherein you have those street vendors who have their carts and they display their wares, and they don't have a permanent source of electricity or battery operated instrument. Many of those places, all you will see is a laminated paper which they have put on their cart. It's got a QR code in it. And the consumers, they open up the app. In this case, it's Alipay app. They scan the QR code and boom, they transfer the payment. Or if you want to use it as a retailer, you could do that. You could use, there as well. You don't need any of those processing machines. Just get your QR code, cashier scan the QR code, money is transferred from user account into the cashier, into the retailer account. So pretty sleek, pretty neat way to pay for it. I don't know why we don't have it in US. I see this in India. Paytm, they are now the biggest payment processing provider in India, have exactly the same technology. What else does Alipay has? Not only they have ability to pay, we talked about they have a money market mutual fund. So this is a kind of a screenshot of Alipay app. You can transfer money. This is the basic functionality of money transfer. They have IPO, which is invest in money market mutual funds. With Huawei, you can get a short-term loans. You can get your credit scores. And of course, you can do all other things which you can do on other e-commerce app. You can pay for movies, shipment, etc., etc. But the biggest stuff is, and which scared the Chinese government, is how big they are becoming in money market mutual funds and in loan, and what Alipay is now doing by moving into insurance companies. At one point of a time, the money market mutual fund, which Alipay had, they had the largest asset under management of any other money market mutual fund in the world. All the money coming from retail investors, those are using Alipay, made that fund so big. It's amazing. The numbers are amazing when we talk about Alipay. How do they make money? And is a broker between consumer and provider. So if you are buying something, you're an individual, you're shopping, this is a merchant, right? And this is being facilitated through Alibaba's website. If you're borrowing something, there's a bank behind it. If you're investing, there's a money manager behind it. So this mutual fund, money market mutual fund, has to go and sit in some financial institution. So Alipay or Ant Group and financials make money because they take a cut on all these transactions. They connect about 100 banks in China to consumers and small businesses that need short-term loans. They got a credit business. Just spend. Huawei means just spend. GB means just borrow. They originate millions of dollars of loans. Banks will underwrite the debt, take the credit risk, and collect payments, while Ant collects a fee for facilitating the transactions. They have no risk. They just collect the fee for being a broker between the banks and the consumers. Now, from an individual perspective, and I don't know how far it is true, again, I don't have any direct contact in mainland China with which I can talk about and see how people are feeling about it. But I do read in articles that people put more faith in Ant than the bank which they would bank with. It has become more powerful than the traditional banks. How people invest, like I said, they partner around 170 asset managers. You want to invest in mutual funds, you want to invest in buy an insurance policy, you can do everything using Alipay. So we talked about this money market mutual fund. It became the world's largest money market mutual fund. They got ability for robo-advisor, which is operated by Ant and Vanguard Group. They got insurance products. Their asset under management company has got $215 billion underneath. Again, all facilitated by Ant. Eventually, that money goes to asset managers, but the conduit for that money is Ant. And Ant make money on all the transactions. Some big money. So it became so big that Chinese government started to have concerns on that this company could actually possess a systemic risk to Chinese financial system. So, and that started to happen, they started to give these feelers somewhere in 2019 or early 2020. I don't know what the exact time was, but that's when the Ant Financial, they changed their name to Ant Group. So they wanted to say, we are not a financial company. We don't compete with it. We're just providing technology. We're a tech company. We're not a financial company. So we should not be treated like a financial company. In China, the rules for financial companies and the standards that they need to hold themselves to are much stricter than what we have in capitalist market in US. So if Ant becomes a financial company or is to be treated like a financial company, they will have much tighter regulations that they need to adhere to. And that's why they changed the name from Ant Financial to Ant Group. Do they make money? Of course, their operating margin is 34%. Unlike other fintech companies in US, Ant is actually profitable. So some numbers about their revenue on the merchant as well as financial services. Okay, like I said, most this geographic location is all in China, but they have been expanding outside of China by doing some acquisitions, etc. Not successful in US yet, but I think in Europe and in some other countries they have. So partnerships exist between Alipay and various European digital wallet companies like ePassy, Momo. But in February, they acquired British international money transfer services called World First. Now in March, Barclaycard will allow British retailers to accept Alipay app in their own stores. But in US, because of all the tension between US and China, it was reported that US authorities are putting restrictions on Ant Group's payment system, which is Alipay. But we still have to see. And State Department's recommending that Ant Group be added to the entity list means then any company doing business with Ant Financial or Ant Group have to take permission from a State Department. I don't think this has happened yet, but this was the recommendation from US State Department. And with change in administration, maybe we won't even proceed with this. Who knows? Okay. The competition is WeChat, which is another big app, in which you can do everything, right from buying goods to hailing ride services to ordering food to transferring money. That's the biggest competitor, but still Alipay handled 54% of mobile payment transactions in 2019. All right, we talked about some of those subsidiaries. Alipay is a mobile wallet. They got a credit card type of product. Maybank is their online bank. This is a consumer loan service. Then they have a credit filing and things like that. They have insurance services. They have a wealth management app. Now they also have international partners. Again, mostly centered in Asia. Now the risk that this company ran into was obviously it is becoming so big that Chinese regulators were getting concerned. And of course, the Alibaba, and let's talk about that before I get into it, is how to invest, right? Forget everything else because we can't invest in these. For us, let's look at investment vehicles. If this becomes IPO, if everything would have proceeded as planned, it would have been IPO by today, but it is not. But that doesn't mean that it will not be IPO. Maybe there will be IPO sometimes later. So if you want to invest in it, you have a direct investment vehicle. Work with a broker in which you can buy international stocks. Or you can invest in Alibaba. And when the news came around that Ant is planning to go public, that's where Alibaba started to move higher. Somewhere around here. And then when the news came in that it is not going to go public, Alibaba dropped down. So Alibaba has approximately 33%. They own 33% of Ant Group. So if you own Alibaba, you get exposure to Ant Group. Or if you get some ETFs, for example, Renaissance Capital, International IPO ETF, they allocate 50% of their money on Chinese IPO. So if Ant Group is going IPO, they will have money on Ant Group. Or you can buy these ETFs which are focused on Chinese companies. So these are the ways in which, if we want to play Ant, we could. So let's look at what the drama happened around this IPO. It was supposed to be listed on Thursday, which is 5th of November. And then suddenly on 3rd, IPO was called off. Because on Monday, on 4 Chinese regulators, their Security and Exchange Commission, equivalent of their banking regulator, their insurance regulator, and one another, whatever bureaucrat, other department head. They called the chairman of Alibaba, and he has the most stake in Ant Group, also Jack Ma, and they called Ant CEO and Ant chairman and discussed with these officials. And on the same day, the banking regulator released some more rules on micro-lending. That means when those rules are implemented, it will slow down the expansion, or it will kind of curb Ant's growth. Also, now Ant will have to do a lot more declarations, have to share a lot more information than they had shared for their IPO. So the moment this meeting happened, Shanghai and Hong Kong exchanges called off the IPO thing. We need a lot more documentation around it. Now, why these things happened? This is China. This is one of the risk of investing in China is it's a Chinese government. If they want to get you, they will get you. And that's exactly what happened with Alipay. So Jack Ma has been a kind of a Steve Jobs of China. If I draw that comparison, he's been an inspiration in China because he created Alibaba, which is a crown jewel in the tech company or e-commerce company across the world. And he has good friends, and he is part of Chinese community, whatever party or whatever group they have. And till now, he was able to get his way around Chinese regulators. As and when this Ant Group started to grow and Chinese regulators started to put pressure, Jack Ma, I think in October last week, made some comments in a conference which was attended by those representatives from those regulators. And those comments didn't go favorable. He made a comment saying, we cannot regulate the future with yesterday's means. There is no systemic financial risk in China because there is no financial system in China. He was mocking the existing financial institutions, says the risk are the lack of systems. And those people who are insiders and have been working on this whole Alipay stuff, he says this infuriated the regulators. And within a week, you asked for regulation, here's the regulation, we'll give you these regulations. That's it. How far this is true? Who knows? But these quotes always come from people familiar with the matter who don't want to be identified. But I wouldn't be surprised if this is true. Jack Ma always speaks his mind. And he's like, don't regulate us. I mean, you're trying to regulate us with the older rules, and you're stifling all the innovation. The current banking system is crap. Then he gets crap handed over. So anyway, this is where the whole drama was. I wish this drama had not happened, and we would have gotten an ability to invest in Ant. I'm still excited by the prospects of this company. So I'll continue to wait and watch. When do they plan to list now? Only silver lining I see from this drama is maybe now they will consider to list on US exchange. Administration in US is now changing and already burned their fingers in trying to list in Shanghai and Hong Kong Stock Exchange controlled by Chinese regulators. US, they could access same capital or even more by listing in US exchange. So that will give us a direct way to invest directly into Ant. And I think that could be the only silver lining. By the way, there was so much retail interest generated by this IPO that of $3.6 trillion were kept aside by retail investors to invest in this IPO. Unlike in US, the way it works in China is if I want to invest in this IPO, I call up my broker and I give him the money that I want to invest $5,000. I have to come up with the money right now. And brokers will hold that money on my behalf, or my investment manager or investment fund, whatever it is. And once this IPO, they'll invest that $5,000. Many retail investors have pledged money, which is now to the tune of more than $3 trillion. So imagine $3 trillion sitting somewhere, not being put to any other use, waiting to be invested in this. And now all this money is being, the funds are being returned to those investors because the IPO has been canceled. This was hugely 300 times oversubscribed IPO. So we'll get back to it. Right now it's been suspended. The IPO has been suspended, but I'm sure once this comes back, we'll be talking about it again. Hopefully, let's see it comes back and list on NASDAQ or NYSE. That would be my best case. And that would be great. Cool. But till then, I'll continue to play Alibaba. That's the only way for us to, unless you have a broker which allows you to trade in international stocks. So that's about all the drama in the world's largest IPO that had almost happened before it get canceled. So like they always say, there's a slip between the cup and the lip. And in this case, the IPO slipped through thanks to Chinese regulators. But that's a risk that we have to bear if we are investing in Chinese equities. All right, any feedback, any questions, any comments? Let me sip some water and then we'll move on to the last sections of today's discussion. Alrighty. Okay, yeah, before that, a couple of things, new things that I want to share. Is one is we started doing Q&A sessions. We did 2 Q&A sessions for patrons or for the people who are supporting me to run these things. One was on October 28th, the other is November 4th. The recordings are up. Those who you have attended it, you can go and get access to those recordings. And the podcast is now will be approaching 50 episodes soon. So if you want to get my thoughts and get some comments from me on what's happening in the markets or things around options, you may want to try this podcast. So recent one I talked about put call ratio, which is we have done 47 episodes. So that'll be a milestone for me. The average, I was looking at the numbers from a Spotify. They say the average the episodes which any podcast has is 9. Most of the podcasts die, after they start, and the average number is 9 episodes. So at that time, I thought I definitely want to run it for at least a year and do minimum 50 before I call it quits. So I am approaching that, my first internal goal. I have done 47. I got 3 more to go. Nowadays, I'll do once in 2 weeks. So I think by end of this year, I would be done with 50. So that's something new at my end. So we want to, the link for this podcast is I think it is in the meetup group. There's a link at the bottom of how to connect with me on the podcast. So I do share some of those thoughts. Let's move into the last section, trades. Oh, thank you, Asif. I hope, if you're listening to, you are able to get something useful out of this podcast. Do let me know, give a feedback so I know what exactly you want. I looked at it, I found that we do have some international audience. 20% of the listeners are from outside US, which was really surprising to me. Let me just pull that up. Here's the number. I'll look at some of the numbers. Oh no, 89. So we have to have, I don't know, someone from Bulgaria, Ireland, India, Argentina. So yeah, but I'm at 47, 3 more to go. All right, let's talk about trades. Right, quick summary. Because of the volatility that got crushed, VIX was down 55% for the week. Lot more trades moved into profitable zone. Let me pull up our tracker and let's talk about the trades. So I closed 6 trades of all the trades that I've been sharing here. And then right now we have 3 trades which are still open. So let's look into those. Trades that we closed this week. And we talked about these trades last week also. And but this week, the wall crush gave an opportunity to close these trades. So we did that. The covered call on PagerDuty, we closed it. Hold on. Okay, now you should be able to see everything. Yeah, so we stayed in this trade for 42 days, decent ROI. The other one was 2 iron flies on XLU. One is centered around 63. Again, we closed this on Friday. This was a defined risk trade. Only thing we were waiting for wall crush to happen. When we opened the trade, stock was at 63.32. So we centered it at where the stock currently was, which is 63, close to 63. When we closed the trade, stock had barely moved. It was at 64.30. We were in it for 4 weeks. No need to be greedy here. November expiration is coming. It's just 2 weeks away. And we all know that the gamma exposure is high as we get closer and closer to expiration. So why I want to take a risk? I just closed it, make sure we can take the risk off the table and take profit to the bank. Other one we closed was a Lululemon. This has gone way up and down many times, but based on the rally that we saw last week, it just got auto closed through my GTC order. So again, when we opened the trade, stock was at 353. This was a put spread. It was a bullish trade, risk defined, put spread with a width of $50 means maximum capital deployed is $5,000. And then we closed it. Stock was actually had fallen down almost $6. It was a bullish trade. Stock was down $6, but because of theta and volatility decay, we were able to exit it as a decent profit of almost 7% in 24 days. Next one we closed was a silver 24 put. I closed a silver 4 put, even though the stock is still below 24, but because we've gathered enough premium. This didn't work out earlier for October expiration, so we had to roll it out. So this was a trade that was being challenged, and we use our option trade management techniques, roll it out, get additional premium, give ourselves more time to be right, and that's what happened. I was right this previous week. No need to be greedy, close it and move on. The next one we closed was a Square. Again, defined risk, Iron Condor. Opened the trade when stock was at 175. After earnings announcement, stock went to 199, almost 200. That worked in our favor. I didn't expect this to come into profit so soon, but who knows, on earnings, these things happen. So we were in it for 14 days. It's 2 weeks, and I won't mind 18% ROI in 2 weeks. And lastly, the sixth trade that we closed was for XLU. The previous one we talked about was XLU centered at 63. This one was the XLU centered at 65 because XLU had moved. And I had mentioned that if it moves beyond 65, I will ladder onto the trade. And this was our second trade, which was laddered on. XLU moved down. It was between 63 and 65. Volatility got crushed. It was the perfect time to take risk off the table. So we closed it. Coincidentally, I actually had to double check these numbers. The amount earned in 63 centered fly as well as 65 centered fly was exactly same. I'm like, did I make a mistake in copying the numbers or is it something else? But I realized no, there's no mistake. Even though these were differently centered, coincidentally somehow resulted in the same amount of profit dollars. So I would say this was a pretty good week from trade closing perspective. So we closed a lot of these trades we have been talking about every week. Now eventually we close these. So let's look at what the trades that we have open. So these are 2 trades that we have talked about in our previous sessions also. Eventbrite, EB. We have a covered strangle on EB. Covered because I hold shares as well. Now it's above $10. I will close this. If it doesn't go below, I'm going to close this on Monday. I don't want to take any more risk at this point of a time because we are so close to expiration. We're just 2 weeks out of expiration and this trade is making some money. Let's close it out. And I would do a similar trade for longer duration. It is way above our break even. So I think this is ripe for closing on Monday if it doesn't go down. If it does, I will roll out the put to December and then maybe sell a strangle, convert it to a strangle by selling a short call at 13, 14 or 15. So that would be my next step on this trade for next week. The other one we had was our hedge trade in which I put a collar around my long position in PagerDuty. So let's go back to PagerDuty. Okay, so on PagerDuty, we had this 23, 25, 35, a collar. Stock was around 30, so we added stock was trading at 29. So we added a collar just to protect ourselves from any big volatility that we might see during election, which we now have not seen it. So I'll rather close this. So this collar trade will protect us any losses below 25, and we had to give up any profits above 35, and I was able to do this for almost just 13 cents debit. Otherwise, if I have to buy just a put, it's going to cost a lot. Instead of buying just the put, we did a collar. This is based on the research report that we had reviewed on portfolio protection, right? So I'll close this one probably next week. And now the uncertainty is over. Now we will move back to our regular sort of a trades rather than doing these collars. So that was the trade that we talked about earlier. And also I had added one more trade to my covered call trade. So we had a $30 covered call on PagerDuty. Stock is already at 30. We have seen this multiple times that we start to get a seller remorse. What to do? I don't want to let my stock go away. Okay, I want to stay bullish. So I sold a $30 put. Now with this, I got a wide straddle on PagerDuty. And I think PagerDuty is announcing earnings after November. So I'll play this through earnings. But now if it gets called away, it will be effectively sale price will be $34 plus, which I think is a decent profit because my cost basis is around $20. So we'll see where it goes. But this is one of a mechanism around if you want to retain shares or if your thought process has changed about your covered call, you could put, add a put to it. So I could have added it to 27, 28, but I went a little more aggressive and converted my short call into a straddle. That's the new trade for this week. I wanted to share. I think till now, all the trades that we have shared. I just wanted to share these numbers in terms of percentage success, right? Most of the time I talk about that, we put $70% probability of profit, and then we try to manage it and increase the probability of profit. So ran some numbers on all the trades that we've been sharing it for a few months, I think since starting from June. Eventually, the numbers do show up, right? With close to 80% of the trades were profitable. And 20%, 18% are losing, and then we still have few trades which are still open. So we'll see. I want to track this session after session to see how these numbers behave. And not only this, when I look at my overall trades, it's a similar story. I have close to 77% profitable trades. But if I include the ones which are managed then the total number of profitable trades go above 80%. So that's why I want to focus on probability of profit more than trying to focus on the direction of stock. And then if stock doesn't cooperate, we'll manage it. Now we have those tools available to us. We'll make use of those tools. So that's all I wanted to share from a trade perspective. Anything else? Otherwise, I just want to talk about the last thing before we close for the day and I'll talk about this company maybe next session, just a teaser. The company is not a leader, but is an imitator. It is following the footsteps of other successful companies. So, for example, this company started with e-commerce because they wanted to copy Amazon. Now, I just pulled in the charts for last 5 years. Amazon needs no introduction, we all know. Then this company added their own payment service. So from an e-commerce, they became e-commerce and payment services. Just like Mercado Libre, they got a Mercado Pago. What happened to Mercado Libre in last 5 years? No surprises there. This stock has been tremendously successful. Then that company recently, in October, added online gaming. Amazon has got a Twitch platform. Mercado Libre doesn't have any online gaming, but C Limited, which is in an e-commerce company based in Asia, has got a big gaming business. So now they're following C Limited. What happens to C Limited over the last 5 years? This is their graph. Then this week, they opened their logistics services to merchants, not only for their own platform, but even the businesses that are not operating on their own e-commerce marketplace. Those businesses can also make use of the logistics services provided by this company. They did it just like JD.com does. There's the JD.com from China. The question is, can this imitator, no original innovation from them, can this be a winner in the business? So we'll talk about this company in our next session. I just want to leave it with this brief introduction here before we call it done.